Welcome to the Truth About Real Estate Investing show for Canadians. I am Canadian, born and raised, proud hockey fan. This may offend some, but proud Maple Leaf fan who probably screamed a little bit too loud for just winning one playoff round. My name is Erwin Cito, and I'm a full-time real estate investor and been in full-time real estate since 2010 when I left my 7-year career in tech at Big Blue to apply my analytical and operational skills to something that would actually build me intergenerational wealth. I've always been someone that was interested in getting ahead in life. I've been investing in real estate since 2005. I've owned over 40 properties that we renovated almost all of them with budgets in the six figures for almost all of them, well over 80% of those properties. Call it burn investing, call it value investing, call it whatever you'd like. I call it logical, practical, and scalable. And scalable because I push for density that gets me higher rents so that the bank keeps lending me money. As an investor-focused realtor here at iWin Real Estate, we've helped clients acquire around 100 student rentals and convert around 100 properties into duplexes. We are every NIMBY's nightmare as we continue to expand our repertoire. We're already executing on some garden and garage suite conversions. In my experience, these are the ideal investments for most Canadians most of the time. And our track record includes over 45 clients who've made $1 million or more investing in real estate properties, income properties specifically, that we help them acquire. What I don't think is ideal is pre-construction for most people most of the time. Of the 40 plus properties I've had in my portfolio, only once did we buy brand new. Those were 5-bedroom student rentals in Brantford that I paid $275,000 for. The cash flow, the numbers justified the purchase. And if you know downtown Brantford, the properties there are generally quite rough and very old. So buying new saved us a lot of time, able to finance everything. It worked out quite well. Compare that to investors in distress who call me, middle-class folks with middle-class incomes who are negative $500 to $1,500 per property. I'm no financial advisor, but I don't think most Canadians can handle that kind of cash outflow. And negative cash outflow goes against basic economic theory of what to do during inflationary times. As we've been in inflationary times forever, and one of the first rules to fighting inflation is to increase one's income, not to reduce one's income. One investor I spoke to bought a 3-bedroom pre-construction condo for just under $1.4 million. Projected rent $4,000, to which I said, "Wow, that's great." Then they shared with me that their occupancy cost is $6,800. So how many months can one afford to be vacant to carry the cost, which is $6,800 occupancy cost? And then even once it's rented, the cash flow is negative $2,800. Yeah, that's why I say for most people most of the time, this is not the right investment. If it were me, I'd try to sell. But rates are still kind of high, and a lot of smart buyers out there, they're looking for a deal, as mortgage appraisals are coming in for less than what investors paid, per the article in the Globe and Mail titled "Looking for Blood: Condos Nearing Completion with Mortgage Appraisals Less Than Investors Paid." So go ahead and read that yourself. I like to read news. Anyways, what novice investors don't realize is that condo builders and / developers, they pay realtors very well. Why do you think realtors are motivated to line up around street corners and whatnot in order to acquire signed properties for their clients? The emails that I receive from condo builders, they have 4% commissions in the subject line and in big bold letters, tall letters in the email body to promote, to garner interest among realtors to sell their properties. And FYI, that's nearly double the rate that a cooperating agent would get on a resale condo. And aside from the short-lived down markets we've had, resale condos have generally been the seller's market for as long as I can remember. So that means seller's market means multiple offers. So buying agents are having to do lots of showings. That takes a lot of time and effort. They're losing offers because only one person can win. Versus pre-construction, it pays nearly double. There's always a good amount of supply. So a good agent may not get as many pre-construction properties each time they line up, each time they do a transaction, each time they work with a builder. They may not get as many properties as they want, but they usually get some. They usually get a couple of them. And again, from a business perspective, from a business owner's perspective, that sure beats losing in multiple offers. So from a business perspective, that means more money for less effort. Kind of like live tour golfers, for those who follow the PGA versus live. But the pre-construction property, again, in my experience, it's not the right investment for most Canadians most of the time. Note that I know many people who've made lots of money pre-construction. We've had past guests on the show. I've had family who've made lots of money in pre-construction, but their timing and the locations they chose were near impeccable, right? Also, they had deep pockets, and again, that's not most Canadians. What have I noticed in my 20-year career as an investor is that those who've been around longer generally have fared better. Investors in BC and Ontario generally have made the most money. Apartment building investments work best when one does not overpay, and renovating when tenants turn over to achieve higher returns. Another commonality I see regularly is no one's cash flowing anything significant. No one's taking money out of their portfolio in terms of operating cash flow after paying their debt, after paying mortgages. Our portfolio is no different, nor did we ever plan to take out cash flow out on a regular basis. Just being conservative investors ourselves. I graduated business school with $30,000 in debt, and now at Cherry we own an 8-figure real estate portfolio, and that didn't happen without taking on a lot of debt. To be honest, no direct assistance from family, and it was only made possible by investing in high density, meaning most of our portfolio is duplexes and student rentals. Without great rents, the banks won't keep lending us money, and along with our day job incomes that help us qualify. Thankfully, we did not over leverage, and our loan to value is quite reasonable. Now, for anyone who follows the news, there's several economic fundamentals in our favor. Cherry and we're well set up for the poo storm approaching. Poo storm. For example, CMHC predicts that home building could drop by 32% this year, and a developer called Stateview in Ontario is having all sorts of financial trouble, putting their 1,000 pre-construction houses at risk. And I feel terrible for the buyers who put deposits on those pre-construction houses, as they may get the deposits back, but they will miss out on all the gains if they were in for any certain point in time. For example, if they had bought the property before the pandemic, there was a lot of opportunity cost there that they're going to lose out on. I personally don't buy pre-construction because I can't stomach the negative cash flow, but I do invest in housing developments, and I only do so because I only do so with builders who are household names. I have a low risk tolerance, hence I'd never give my money to a builder such as Stateview, as they only have their experience is only 200 units. So I literally went to Stateview's website and counted up all the units of their completed projects. So across like 5 or 7 projects, 200 units. I'm more interested in working with someone who's done like tens of thousands of units. And sadly, speculators will pay a hefty price. And then in recent news, just this past weekend, another U.S. regional bank, First Republic Bank, is failing. The original headlines were that the government would have to take them over, but actually what happened was as of right now, they were acquired for pennies on the dollar. The stock was $115 in March earlier this year. Now, this morning, it was $2.30, down from $1.15 to $2.30, and the new owner is JP Morgan. How many more banks in the U.S. fail? Nobody knows. But investors do remember, bank turmoil equals cheaper interest rates. To get into the details, the markets have a flight to risk. They sell off their equities generally to trade them in they want to buy bonds instead, which they consider safer, and that makes bonds more expensive. That makes the bond yields lower, and then bond yields translate into our mortgage fixed rates, and if the yields are lower, then our rates are lower. So with cheaper fixed interest rates, that just means more fuel for the fire for our real estate market. Just over a year ago, I shared with you all on the show, back in January, February, I was sharing that the short-term timing to sell was right. Fortunately, I was correct, and many of you listeners and clients nailed that peak. Now the pendulum has swung. It's time to buy, and if you want to learn how to, I can't recommend enough that you sign up for my email newsletter. Sign up today and receive timely updates on when new podcast episodes are available, and to be the first to know about upcoming events. And some of our events do sell out, like the iWin free training events, which are delivered via webinar these days, and our iWin mastermind tours, which are in person, on site, inside property, inside actual income properties. So those do sell out, and so you do not want to miss it. We've already actually just announced our next tour, June 3rd, east of the GTA. So again, these events sell out. The last two sold out within 5 days, so you do not want to miss this. And our newsletter is the perfect way to stay connected with us and stay informed about all the exciting news that we have in store. Don't miss out. Sign up now and join our community of engaged and informed 17 listeners. Where to find it? www.truthaboutrealestateinvesting.ca. That's also where I post my show notes. When I always say, like, hey listener, don't worry about writing down all this information. I post show notes on the website, www.truthaboutrealestateinvesting.ca. As always, we'll tell you how it is. We're going to keep telling you the truth about real estate investing and how to be a successful investor in Canada. The real estate investing community is a big one, and it's gotten a lot bigger. Hence, I've had a lot of requests, a lot of folks who are clients of other coaches out there, and then one reached out to me. So I was speaking to a newer investor who took a course and was instructed to use I hope you're sitting down, to budget for his for two six-figure renovations, probably in the tune of each renovation should be around $750,000. That's my experience. So this young gentleman has two renovation budgets plus down payments. Renovations and budgets alone should each be in the six figures. And part of the course this gentleman took, he was instructed to budget for the use of his personal line of credit for the renovation. I shared with him that's not something my clients or I would ever do, especially when the investor is a first-time investor and bought two properties back to back over a short period of time. So this investor has two vacant properties at this time that have no money coming in. So, and that personal line of credit now costs 9% interest. To me, that's a lot of risk. Why not at least just do one property? Again, this is their first investment income property, their first BRRRR project. Why not just do one? You could cut your risk by more than half by just doing that. He asked me how his other follow-on question was, how does he avoid shiny object syndrome? And those objects are different investment strategies. So I'll share with you, my 17 listeners, what I told this young investor. I told him to turn off social media, as it's mostly lies. He was smart and then asked me if my own social media is lies. And I said, yes, partly so. I change my shirt and style my hair and I'm well caffeinated before I turn the camera on. And honestly, I'd rather not share my investment journey, as I'm an introvert, a private person, and generally people do not share their investment journey. But I have to, because I am here working. I'm working right now. It'd be terrible marketing and terrible social proof if I did not share with my listeners and my clientele that we do have, for example, 350 successful investor clients. And they generally fit the mold of The Millionaire Next Door. If you haven't read that book yet, please do. So anyone who's posting on social media, as I generally say, they have something to sell. Someone who posts a lot. Again, I'm one of them. But how else would I explain that me and my team at iWin Real Estate, we've transacted on over $400 million of real estate. Almost the vast majority of it was small multifamily and student rentals since 2010. And it doesn't take a rocket scientist to figure out how investors have done since 2010. They've done extremely well. Not everyone selling stuff out there is bad, but there sure are a number. There are a number of good investments, but it's buyer beware. There are way more bad ones than good ones. Otherwise, everyone would be rich, and you wouldn't need this show, and you wouldn't need me exposing people who've gone to share with our audience people who've lost it all, right? And that brings me to Alex Solga. So just as an update on the Alex Solga episode, Alex has gone bankrupt. He's lost everything. The show will not be aired as Alex asked that it not be shared, and also because I believe that through our conversation, it would likely be used against him in a court of law if that ever happened. So I'm not interested in being part of someone's prosecution. So at least know that I know the truth about real estate investing and how he lost it all and who was party to that. Anyways, so something I've learned in my investor journey, is that if one wants to build real wealth, direct ownership of physical real estate is the way. It's by far the easiest and most reliable path to building intergenerational wealth in my experience. It's worked for me. It's worked for many people, many friends and family in my life. And anyone who's not owning at least one property in Canada is going to get left behind, while those with multiple properties get ahead in life. They really get ahead in life. Speaking of multiple properties, today's guest is Michael Ponte, and he's an old friend of mine. We're old guys. We have way more gray hair than when we first met back in like 2010-ish, 2009. Again, people who've been buying properties through the years, and especially us old RAIN members from over 10 years ago, we've known each other and we all run in the same circles, and it feels like forever. And funny enough, forever is probably the perfect time horizon to own real estate in terms of maximizing money returns. Michael owns with partners apartment buildings across the country in British Columbia, Alberta, New Brunswick, Nova Scotia, probably Saskatchewan too. He probably said it, but I missed it. Michael is a savvy investor, and that's the social media handle across pretty much every platform: Instagram, YouTube, Facebook. Savvy Investor, and that's also the name of his private investor group with over 5,200 members. Michael, being old school, he's investing successfully in the multifamily apartment building space, and he has no trouble raising capital. He's a bit of a pro at it now, and he educates others on how to do so while he lives out in BC. That's a special thing. Like, Michael does not invest locally, mostly. He lives in BC, near Vancouver, but most of his portfolio is well out of province. On today's show, Michael shares how he's navigating today's interest rates, how multifamily is fast money. I'm kidding, it's not. Michael's words, not mine. You'll hear him tell you the truth about real estate investing. There's not a ton of cash flow in multifamily investing, even though there's tons of rent money coming in. He walks us through the numbers of a couple of apartment buildings, including how he finds the deal, the different phases and costs during the due diligence process, seller financing, screening joint venture partners, what the biggest mistake an investor can make when buying an apartment building. And if you wait till the very end, we'll discuss, Michael shares how he thinks a new investor can get started. If you're interested in apartment buildings, you definitely want to give this episode a listen to. And I'm sure there's many of you out there. As I know, Seth's multifamily conference, the ticket sales have been massive. I know I'll be there. I have a booth in case you want to come by. I'm not sure if Michael's coming by, but there's a whole lot of people from all over the country that are going to be there as well. So if you haven't got a ticket yet, it's www.multifamilyconference.ca. My discount for you, my 17 listeners, is IWIN. That's 4 letters, IWIN, for 10% off. I'll see you there. And please enjoy the show. Hi, Michael. What's keeping you busy these days, other than flying across the country to be here just for this show?
I am here.
We're that important.
I am here for you, Erwin.
And our 17 listeners.
And the 17 listeners. Yeah. And probably less because they see me coming on. So. Crap.
Why, did you warn your mother that you're coming on the show?
I did. I gave her a heads up. Yeah. Come and check it out, Mom, please. Yes. Okay. Yeah.
Right. I'm gonna need, before you leave, I'm going to need a list of 8 people you're going to send this to.
Done. Now we can make that happen, I'm sure. Yeah.
Get it back to 17.
Let's get it back. Yeah.
All right. What's keeping you busy?
Oh, what's keeping me busy? Well, it's tax season. Obviously, that's one thing, right? That's always one of the fun parts. Not really, but it's so nice to connect with your wife here as well. And I'm like, I feel so sorry for you. No, tax season's keeping me pretty busy. And I think there's lots of things that are keeping me busy is exactly what everybody's kind of dealing with right now. Interest rates are going up, and how do we kind of pivot and adjust and manage through all these things? It's just a day in the life as a real estate investor, to be honest with you. It's just, interest rates go up. So how are you going to manage that? And, been there, done this. We've kind of gone through cycles as well in our real estate world. So, we're looking at raising rents, making sure tenants are paying their rents. We're looking at, what are the banks going to be able to do to accommodate this? I'm not sure if you're aware, but, banks are making some concessions in regards to maybe extending amortizations on some of our mortgages. So we got to sell the story here and try to maintain some of the things. We're in a fortunate position at the end of the day. We've always had, investing in cash flowing properties, and we're sustaining it. But at the end of it, we got to protect ourselves. Interest rates are impacting obviously cash flow across the board and across the country. And so we want to maintain that. And so we got to look at our business just like anything else with cost of inflation going up. How are we going to mitigate that? So we're, having discussions with tenants. We're talking with our property managers, building strategies. Sometimes there's vacancies that are part of that. So renovations are being done, raising rents. So it's all that kind of wonderful stuff. But yeah, it's busy. It's really busy with lots of different things. So
to continue to overwhelm our 17 listeners, how many units are you talking about here that you deal with?
We've got over 225 units across the country.
Right, and you can name all the tenants, right?
No, I can't. In fact, I can't even name one of them, to be honest with you. That's not my job.
You know their birthdays.
Yeah, I do. Yeah, no, I don't. I barely remember my own.
225 units across how many properties?
225. So we have got, it's over 75 properties across the board.
Okay, properties. Are you impressed yet, Adam? And then I'm just teasing. I had another question. That's a lot of rent. I won't ask you how much rent.
It's quite a bit. And it's been kind of, that's current portfolio. And we've had, buy and sell. We've sold a bunch of properties too. And we've bought. And over the last, 22 years of doing this. Long time. 22.
And then for the listeners' benefit, can you explain how the mortgage, because you're talking about interest rates. What did you do in the past? Do you have a mixed portfolio of variable and fixed, or?
The majority of the portfolio is variable. But in the last year and a half, we were trying to catch some of that stuff a little bit early. So some of our residential stuff, we've stayed variable just as long as making sense. And then we've also fixed them. To be honest, Bank of Canada came in pretty heavy with a lot of the rates, so we didn't anticipate it to some of that level. And so for me, I'm trying to always, as an investor, you want to always kind of take a look 2 steps ahead. So I call it the Mike Ponte crystal ball. And sometimes it's very foggy, and you're trying to just make the best assessments that you possibly can. So my anticipation is that, in the next 2 years, and I am playing kind of worst case scenario, rates will come back down. I don't believe they will coming back down to the levels they once were before.
Those are emergency rates.
Emergency rates. So we can't anticipate for that to kind of happen, right? But let's just say it sits at 4.25%, 4.5%, and that's kind of what we're budgeting into our numbers
as the variable,
as the variable rate at some point in time, right? So we're looking at 2 years out. I'm like, do we want to fix these rates right now at 6.3, 6.4, 6.2 right now, or do we just stay the variable rate? Try to find ways just to mitigate some of the challenges, raise some of the rents, and see what we can do. And then at some point in time, we'll revisit the mortgage in the next year to 2 years at that point. So, if we are fixing them, we're fixing it for a 1 to 2 year term. In some cases, we are sitting on a variable rate. Most of our commercial properties that we own, all apartment buildings, are on fixed rates. And I've been, knock on wood, very, very fortunate. All of our mortgages got renewed prior to or just around the COVID time. So we had some great rates. I've got one mortgage right now that's like 1.89% for another 3 more years fixed. So, we're just making tons of cash flow out of this property right now. So I've been very, very fortunate. But again, our job right now is just raising his rents as much as possible, because we know when we start to renew those in 3 years from now, we're dealing with a different situation where the rates are going to be up at that point in time. So yeah, so we got a kind of a mixed bag of both variable and fixed rates. So
with bond rates coming down now, are you looking to do trying to grab any of these fixed rates now?
Well, we were just looking at some rates actually before I got here. We're still kind of at that 6.2, 6.3. So the answer is no. Like, if the plan is that we are going to renew, if we're looking at the mortgage rates maybe coming down in a year or two, we just got to take into consideration what the plan is for our strategy, right? So part of this, and again, this is my 2 cents, so don't quote it. My gut feel is we've got probably 1 or 2 more increases coming in for this coming year. That's my feel. I think we got another 1/4 point coming up very, very soon. And again, gut feel that there's probably 1 more coming in probably August. So we are kind of planning and preparing that's going to come to fruition. And so, we're still very closely aligned with the US. And so whatever they're doing, there's going to be some implications to this thing. And there's still some control on inflation, even though inflation's starting to kind of come back down. but I still think there's some pressure that needs to be managed. They're not seeing some of the inflationary pressures. Even though inflation rate's gone down, there's a lot of factors that haven't gone down. Like just look at groceries. I've got a 20-year-old daughter and a 18-year-old son. As 4 adults, it's not cheap for anybody. It's really expensive. So with that being said, I'm kind of planning some of that stuff out, but at some point in time, those pressure is going to have to get relieved at some stage. And so that's why we're saying, in the next 2 years, again, it could be even earlier. But even if it's a year, we see rates start to kind of come down. We can start to assess maybe some renewals or early renewals on some of those mortgages if we see the banks reversing their strategy at that point. So
if they're still around.
If they're still around, yeah. Oh yeah, it's kind of crazy out there, right? Yeah.
It is crazy out there.
is.
And just to add to that, with all this banking trouble, that was kind of what triggered the bond yields to come down. And who knows? Like nobody knows if there's not more issues out there.
We don't know. Like I said,
knows.
nobody knows.
Nobody knows.
I can guess. Like I said, this is the Mike Ponte crystal ball. I just kind of look at what the numbers that are available to me. I know economists probably don't. Nobody really kind of knows.
No one can predict when the Ukraine war ends. I think a lot of people were really wrong about when the war would end.
Completely, right?
I don't know if anyone saw these banks having troubles like the way they are.
It's a big shock. Like in some cases, very, really, really big shock. So
totally, Credit Suisse is gone.
Who would have thought? Like you would think that would have ended back in 2018. Here it kind of reset.
Yeah, you survived that.
You survived that, right?
Yeah, like you survived the ultimate stress test.
So crazy. Yeah. So crazy.
Some people fail to learn from history.
Yeah.
That's actually a good segue into, I don't know what next. We talk. So you have a, what do you call your group? Is it an educational group, a networking group, a mastermind group?
That's a good question. Well, it kind of started off from COVID as we started it as kind of a simple group. And so our group's called Savvy Investor for those that know me or don't know me. We've got a pretty large Facebook community. We've got about over 5,200 members across the country that are active investors. And it's just our Facebook group. And it's a community where people can kind of come together and talk about real estate investing, share their stories, celebrate their successes. If you're looking for support and ask questions, kind of an open place. The one thing you're not going to find is deals, investment deals or any of that. It's a place to kind of support each other. And that's what our community is to begin with. And then
it's $9.99 a month for the deals one, right?
No, there's no deal ones. No deal ones. No. It's not that type of program. No, it was kind of really designed for a place to kind of have those like we had a meetup in Vancouver back in the day and COVID hit and that kind of disappeared. I'm like, let's throw this on as a Facebook group and see what happens. And it just kind of exploded actually for a while. And then, so that was our Facebook community called Savvy Investor. And then a lot of people were asking about education and training and stuff like that. And it's something I've always done. I've done it for years, but it was done as a live setting. And we've always had like 10, 15 people in a classroom setting and all that. So we did it virtually. And so, and that's called Elevate Academy. And our courses are called Elevate Masterclass. Which kind of runs 3 different programs: fundamentals to residential real estate investing. So kind of foundational stuff for people that are just getting started, raising capital through joint venture partnerships. And then for everybody's favorite topic, I'm sure, is multifamily investing. So we do that as well. And then we have a separate group called Elevate Mastermind. And that's not people learning how to invest. They already know how to do it. It's more kind of business-based, business focused. So for those that are wanting to kind of scale their business, but just don't know how to run a business, and so it comes to marketing and systemization. We had your lovely wife join us to talk about accounting systems to put into your business and how to systemize that a lot better. We bring in guest speakers literally from all over North America. We got an amazing lineup of guest speakers from Bigger Pockets joining us this coming year. Been really wanting to bring in a lot of American speakers, which kind of sounds weird, but they just do everything bigger. Like just everything that they do is big. And so we wanted big thinkers to kind of change kind of our mindset a little bit and expand this kind of funnel process of some of the things that they're doing. It's quite interesting to watch some of those guys. So yeah, so it's a fun community. It's a great place for resources, great place for learning. And like I said, at the end of the day, it's just really trying to support our members to help them learn how to invest, but more importantly, support them to kind of deal with the challenges that real estate investing does have. It's not all Lamborghinis and pimped out boats and all that stuff that you tend to see out there. There's good days and there are bad days. And do you have that support group and support to help you kind of mitigate and manage through some of that stuff? So,
Right.
yeah.
Who you surround yourself cannot be more important than ever. For example, I mentioned before we were recording, I'm really happy to have yourself here.
Thank you. I appreciate being here.
As a palate cleanse.
Appreciate that.
The bar is so low. Because honestly, our last guest, and that episode may never see see public, whatever, it doesn't matter.
Yeah.
But I certainly believe he surrounded himself with the wrong people.
That's fortunate.
Like his coaches are doing really poorly.
That's too bad.
Other people he attended courses with are also facing the same challenges he is, as in the bank. The bank has questions. JV partners have many issues. You know, yeah. It's bad out there. So like you said, just like you said, it's not all Lambos and all that. It's not all chaos too. Like I've had some guests on.
For sure. Like there's opportunities. There's lots of good stuff out there. You know, unfortunately, the bad stuff is the stuff that kind of sticks sometimes, right? And so
it hasn't stuck for a while because you didn't have to. It was pretty easy to make money.
Yeah, that's the thing.
But you've seen the ups and downs.
Been doing this for 20 years. And that's the thing, you know, for a lot of people, and I'm from Vancouver, so I can appreciate some of the challenges that are happening even in Ontario for those that are listening to us from Ontario. It's like, there hasn't been a downturn in this market and in Vancouver in roughly 20 years. It's all been kind of up.
Yeah.
You buy something, prices go up, and you put a smile on your face. Everybody's an amazing investor. Everybody's an amazing investor.
I'm a coach now.
I bought 2 properties. I'm going to coach you about real estate investing, right?
Yeah.
That's all sunshine and roses. But this is times like this, and I've shared this before, is times like this actually make you a really good investor.
Yeah.
Nobody wants to hear this because people are challenged right now. I get it, and I'm not discounting any of the challenges because I have been there myself. Period. Okay.
You're an Alberta investor.
I've been through this before several times, and I'm sure this will not be the last. Okay. It's just part of what it is. But I'll be honest, I sleep really well at night. I do. I know for a lot of people that they don't because they've not gone through this kind of stuff before. So with that experience and knowledge, you just kind of go back to your experiences and look back at some of the things that you did and repurpose some of that stuff back again. Is it challenging? Sure it is. It's always challenging. But it does make you a better investor, and you're riding a cycle. And so with that, it's just like, yeah, it can be really, really negative. And you can be surrounded by this. And I've talked to a lot of investors out there that have reached out to me and said, Mike, I'm in trouble. And this, I'm sure you've probably been connecting with people too. It's a lot of people are reaching out to myself that had a lot of experience. And, I've known Erwin for years too. He's been in this business for a long time. So
I've been mostly sunshine and rainbows though, to be honest.
Yeah. But saying that, it's just like you go through these types of experiences and you ask advice and stuff. And I hate seeing people kind of going through those challenging times. You really do. And you try to support them to the best of or give some suggestions to the best of your ability. But to go back to exactly what you said it is so important to surround yourself with those types of individuals, engage and talk and be open, because in this game called real estate investing, you post something like this on social media and Facebook, you don't want to share some of that bad, negative stuff. And then it gets to be a little bit of a lonely place. Right. And so with that being said, you need to talk these things out. You got to talk to people about your challenges because somebody else is dealing with the same thing and they may have found a solution, or they're, ask the question, how are you kind of managing through some of those things to help support you kind of to get through it. Right. Or else again, you can feel like you're in this small little tiny island. And I say that because I've been there too. You just don't I don't want to disclose that. Oh my God, I'm in trouble with this property. This property's not doing well. I don't want to talk about this because they're going to make me look like a stupid investor. No, you need to share this stuff like that. It actually, by sharing, you're actually helping teach other people mistakes that you've learned. Those are the best lessons from my perspective, is share the bad. The more you share, the more you can talk these things out, the more you're also supporting other people as well to learn from those mistakes too.
So let's you mentioned earlier, you're having to raise rents. How are you doing that? Is that partly a function of the markets that you're in that do not have rent control? Because I'm sure you're in some markets that do not allow it. But
in all the markets that I'm in, with the exception of a few properties in BC, they are there's no rent controls. So I'm in a very fortunate position, to be honest with you. Halifax is the only one, as well as in some of my properties in Fort St. John. So with that being said,
I'm sorry, where's Fort St. John?
Fort St. John, BC, northern BC.
Okay. Thank you. I was going to think
it's like Fort St. John. Where am I going? Yeah. So it's cold, snowy. There we go. So
part of Canada. Yeah.
Part of Canada, north part of BC. Yeah. It's so we got some properties up that way as well. So so with the exception of those few, rents we're raising 18 to 20%, somewhere in those vicinities. Yeah.
Is that in BC? Sorry, is that in Alberta?
That's in Alberta right now. Yeah. So Calgary and Edmonton, we're seeing rents going up like crazy. Vacancy rates are actually quite low. We have a very, very low vacancy rate in both of those markets right now. And rents are actually going up. Yeah. And like Calgary, as you're probably well aware, it's appreciating. It's an appreciating market in this environment because of affordability, right? Mm-hmm. So,
and it hasn't been in this for
years. I think it's only been recent. Like I said, it was starting to hit kind of last year, just around late summer. It started to kind of hit.
That late, eh?
Mm-hmm.
Sorry, I'm ignorant.
That's okay.
Because you in Vancouver, BC, weren't things skyrocketing during the pandemic, just like it was here?
Totally. Like in Calgary wasn't, and Edmonton wasn't. They weren't doing that. But then all of a sudden, with interest rates going up, as you're probably well aware, there's not enough money in people's pockets right now. People's debt loads are just skyrocketing right now. And so when, some of the concerns that we're seeing in Vancouver is the same that we're seeing here is mortgages are going up through the roof. People are over leveraged. What I'm finding right now is people are paying debt with debt. So they're using lines of credit just to get by. They're using credit cards just to get by. But as you know, that can only be sustained for so long.
Yeah.
So
interest rates to get you.
So with that being said, people are needing to make some serious decisions right now. And one of the biggest decisions is, I can't live where I live today because this is eating us. What are we going to do? And so I was sharing this in another interview I was doing. It's just like people are moving. Like they are migrating outwards from wherever major city is to be more affordable. And very fortunate, as we just talked earlier, is people can work from home. They may be just traveling a little bit further to go to work for that 1 or 2 days that they have to go to the office. So we're seeing people's commutes go a little bit longer. Some are taking even bigger drastic measures where they're moving to different provinces altogether. The migration, we just saw some of the recent stats I think it was just a couple of weeks ago. The migration trends is people were moving to Alberta. The biggest was population changes from Ontario and BC going to Alberta. Right. And the biggest part of that was going to Calgary to begin with, right? So
you have an idea of the split that went to Calgary?
I don't know the split between Calgary and Edmonton. I could.
Calgary's. I've never been to Edmonton, so I can't comment on that. But Calgary's quite nice.
Yeah, Calgary's pretty nice.
And again, just my context, if I drive 3 hours north, the weather's very different. Is that the distance? 3 hours between the two?
Between the two? It's about 2.5 hours.
Okay. Yeah. But again, the weather's different. I'm sure it's the same BC. You drive 2.5 hours north, the weather's different.
Edmonton is going to be colder than you would see in Calgary, but in Calgary, you'll get snow in the middle of June, which you get these little Chinooks that tend to happen. So you'll see kind of those slight variations that are there. But Calgary's a beautiful
The mountains are pretty.
Mountains are gorgeous. Beautiful. You go to Kananaskis, you go to Banff. It kind of feels a little Vancouverish, to be honest with you. It's quite nice out that way, right? So like I said, you're looking at, if you could buy a house, if you go to Edmonton, for example, like you can, it's going to be maybe surprising for a lot of people. What's the cost of a townhouse here in
we're in Oakville, right?
In Oakville. What do you think? 3 bedroom, 2 bath.
1.2, Adam?
1.2.
Sound right? 1.2.
Sound about right? Yeah. Okay, 1.2. So in Edmonton, you can get a townhouse there for under $200,000.
See? How old is it?
It's old. It's older, but don't fool yourself. You'd be surprised, and that's actually quite renovated. So it's like it might be an older unit, but it's renovated. And even if you want to go to the higher end or 250 to 300, that's what we're talking about here. And so when you start kind of you go back to the old 10% rule ratio or the ratio rule or whatever, there's that ability to accommodate that. So there is cash flow that can be generated out of those things, and you're investing in. But more importantly, is just if people want to live in Edmonton, for example, they can take a lot of their equity that they've earned here and moved there, and their mortgage is now kind of maybe gone for something like that, right? So it depends on really where, the biggest issue that we see is affordability. It's just debt loads are just too high, and people are needing to make some drastic decisions and drastic changes.
And that affects us as investors as well.
100%.
Because I'm going to guess your Fort St. John properties are expensive.
Fort St. John is not expensive, not compared, but it's more expensive than your Edmonton market. I would say it's closer to your Calgary market.
Mm-hmm.
Yeah.
And so the nice thing about talking to you is because you have kind of like a national view of real estate.
Mm-hmm.
So where are you looking to buy next?
So our focus, so we got actually just a couple of days ago, we got a 22 unit apartment building under contract in Calgary, just outside of Calgary, actually. So we just locked that up. I shouldn't say we locked it up. We've got it under the first stage, under the due diligence. So we're just going through that process right now, just reviewing all the numbers and the assessment, and then we'll see what comes out of that right now.
What's part of your due diligence phase? Like how long is it? First of all, how long is it? How long do you have to do due diligence?
Yeah, so there's
5 business days?
Yeah, well, normally I try to push a week. I try to do, well, if it's 5 business days or 7 business days, but there's one little clause that I always like to put in our contract. So for those that are listening, pay attention. I always like to reference the clock doesn't officially start until I receive all the documentation. So what happens is there's a big laundry list that they need to provide 2 years worth of financials, rent rolls for the last 2 years, lease agreements, all sorts of information. So that needs to land in my desk. So once I check off all of those boxes, then the clock starts. Okay, because what happens is people are a little bit, what's the right word, lazy. So with that laziness is you might get piecemeal of this and this, but your clock's already started.
They're not ready for this.
They're not,
it's not in a Dropbox somewhere. They
you would think, right? And then some of the stuff.
Professional investors, come on.
Oh no, they're not. And then you got handwritten financials, and it's just like,
no, you don't.
You do. You'd be shocked to see what you deal with, right?
They give you a paper ledger.
No, I wish they gave us a paper ledger. It's pretty bad. It's really bad in some cases. Some people are very organized and buttoned down. But I hate to say this, some of the best deals are actually people that are bringing you in the paper ledgers, to be honest with you, because they're mom and pop. They don't really kind of know what they're doing in a lot of ways. Right. And,
it's not because they're mom and pop. It's because if that's probably an indication of their larger management style. It's not completely efficient. They haven't extracted most of the value out of everything. They haven't.
Right. And when I say mom and pop, I actually kind of still do say mom and pop. Like these guys are they bought into this property. They maybe owned it for 20 years or 30 years. In some cases, some of my best deals are actually second or even third generation owned. So they've just inherited these buildings, literally have no mortgage on them. Susie's been renting the property for 30 years. Okay. And she's getting rent for a two bedroom unit for $625 a month, including utilities. And that rent should be $1,100 a month, not including utilities. So here's where you can CapEx a lot of this stuff without doing a lot of work. Right. But for the existing owner, they're just like, I'm getting cash flow. I don't really care. I want to keep Susie in there. She pays rent on time and we're good. But they've not done themselves a service because they've not increased the valuation of this stuff. So like I said, they can be mom and pop. They can be more sophisticated. So due diligence process, to go back to your question, on the number side, it takes about a good week, 5-7 days, as long as you got the information ready to go. And then once the due diligence has been completed and accepted, now we kind of go to the phase 2 of the due diligence, which is, going through your financing, get it appraised, environmental study, engineering report.
You need all those things in a 22 unit?
Oh yeah, you'll need all that stuff. Yeah, for sure. Yeah, the bank's going to be requesting it and they're going to be asking for it. So, and part of it is you should be doing your own due diligence on all of those things just to be safe. So it's one of those things that's extremely, extremely important. So especially in an environmental study, like in a lot of cases, they're going to come clean. It's funny, I was coaching one of my students and he had a property under contract. The issue was there was a previous gas station right beside his building. And so what happens is it automatically flagged that there was a gas station and there was concerns that there may be some potential oil going into his property. So there was a phase 2 study.
Is it the lender that's concerned? Or
the lender would have been concerned with this, right? So that study could cost quite a bit of money. And if there's any, contamination, the cleaning process is quite significant. So here he had to go back to the seller and say, listen, this has got flagged and this is now going to need to go a phase 2 study. I want you to pay for that study and to mitigate the risk. If it goes through and everything passes, I'll pay for the study. But if there's any contamination, then I have the ability to walk away and you pay for the study. Mm-hmm. So these things kind of were helping him kind of figure these things out because this is all new. And so just got to be careful with all those pieces. What you're trying to determine, and you can appreciate this, is when you buy like an apartment building, you're not buying a property at all. You're actually buying a business. And so it's based on valuation. And so you're trying to determine, is the business performing at kind of what market standards are for what this business actually is. You know, apartment building has more correlation to like a coffee shop or I'm trying to think of some other, a clothing store or something like that, where it's all based on sales, and sales here is rental income and offsetting expenses and all that stuff like that. So they want to determine is, you know, current market cap based, you know, current market cap, similar to what this property's value is. And so they're trying to understand what valuation is on this particular property, right? So, so those are just kind of a few things in it. But yeah, it can take, you know, for those that are looking to get into this space, 2 to 3 months, 4 months, 5 months is not uncommon to go from the beginning of getting the offer accepted to closing. It just depends on all the things that you've agreed to. But there's it's quite a process for due diligence. So,
anyone ever resisted you inspecting suites? Besides tenants, sellers?
The sellers, not necessarily. It's just kind of common.
Trying to hide anything?
No, I can't. Actually, that's not true. That is that they did actually, and it was quite.
So just to pause you there. I think you mentioned a previous guest we had on the show. And I won't name names, but
sure.
I find if you're a novice, like say you're within 4 or 5 years, I generally find you don't know how many sharks are out there.
For in what space? As a seller, is that what you're saying?
In general.
Oh.
I'm sure you've run into sharks as sellers.
Oh God.
They will eat your lunch.
Tons.
They'll eat your feet. I don't know.
100%. 100%.
But they'll take everything they can from you.
100%.
Right.
Yeah.
So that's kind of my point. Is like the caution. Always caution.
Totally. 100%. Like, you know, it's.
I imagine you've been handed fake numbers before, or like cooked numbers.
100%. In fact,
that's the truth of real estate listeners.
That is the truth. Okay. So I joke around, but I'm not joking. This is the real. And I tell my students the same thing. When you get a copy of a pro forma, and I love our realtors, just so you guys know, I love you guys all. Property or pro forma comes to you. Okay. And you are basing your offer based on what the pro forma is stating.
Yeah, of course. Because we're buying a business.
You're buying a business.
Yeah. We're buying a stream of cash flows.
Exactly. Yeah. And so you anticipate that those numbers are being accurate. So you present your offer accordingly. And I tell my students the same thing is 90% of the time that those numbers are not accurate. 90. And in fact, I think the number is even higher. Okay. And for our realtors, to defend our realtors, okay, to defend them, you're only as good as the information that you've been provided by by the seller. So I respect that. So that's been come to conclusion. So know what you are buying, that pro forma. You got to go in knowing that those numbers aren't going to be accurate. And so here's my kind of rule of thumb, and you reference sharks. And so I kind of reverse engineer it, to be honest with you. So when I look at a deal and a pro forma comes my way and I'm about to go to the process of due diligence, I go in it with the mentality is, how are these guys screwing me? And then work my way backwards.
That's me too.
Yeah. It's like, how are they screwing me? And then by the time I come to the conclusion, there's always a little bit of kind of screwing that tends to happen, but am I comfortable with that percentage, or is there any concerns, and can I negotiate that aspect of it? But trust me, by you going with that approach mentally and you're like working that way backwards, it makes you scrub the numbers really, really well and determine what's kind of going on, because that's what it is. And it pops up in the numbers, and you start to measure these things. And then more importantly, it can help you become more sophisticated when you're going back to renegotiating with the sellers when you need to, right? So
are there any common areas that numbers are not as refined or accurate as they could be? Like, for example, I'll throw one out there. Like, for example, some owners manage themselves. So they factor in nothing for management.
That's exactly it.
That's maintenance even, because if they're doing it themselves.
100%. Maintenance, property manager are number one and number two, right? And so you should always budget property management unless you truly want to be a property manager, which I don't know what anybody want to do this. That's going to be a limiting factor for you. If you want to scale your business and you don't budget property management, but you need to do that, like you need to remove that expense just to make the numbers work. You can fool the numbers, but at the end of the day, you're only fooling yourself, because, if you've got plans that you want to own like 100 units or whatever the case may be, you're not going to manage this. So you're going to have to budget those numbers in advance. So plug those numbers in. The banks are going to put those numbers in anyway. They're going to put that 4 or 5%, 6% in there. They are going to put a repair and maintenance level based on, 5 or 6%, looking at the age of the building. They're also going to be budgeting a vacancy allowance. So those things need to be captured in those pro formas. They're immediately removed to make the numbers look better. But now you have to go back to the seller and say, hey, banks don't look at it this way. You got to kind of adjust some of these things. But some of the biggest ones that I tend to find is a lot of the maintenance expenses aren't maybe budgeted, aren't being referenced as they should. Sometimes as utility costs. It's very uncommon. Rents are not being disclosed accurately. But I've seen situations where they've provided me with kind of a fake lease agreement from fake tenants, and the owners were paying for it. So they were just trying to show that the building was full when it actually wasn't full. And so they're just trying to throw that into the numbers right now. So they technically, the owner was kind of technically paying the rent, which is fraud. Exactly. And then all of a sudden the property becomes vacant all of a sudden, right? Just as you're about to disclose, right? But again, these are the things that you need to do is when you're going out to go take a look at the property, you need to check out every single unit. When you see the unit is empty and it's showing rent,
you have questions.
So it's check and balance, right? So then you look at what the pro forma is saying. What are the actual numbers kind of showing? And is there a match, which normally there is not? Then you can renegotiate and you can say, okay, Mr. Seller, I thought I was buying a property that was a 5% cap rate, but based on what the numbers that you've presented me, it's a 4% cap rate. So where, these are what you told me and I thought I was buying that, but you're not. So to make it a 5% cap rate based on what I thought I was going to buy, this is your new price that I'm going to be renegotiating with. And then we start to kind of go through that process. So
fun. Another favorite of mine is projected rent, assuming full vacancy. Assuming full vacancy. Sorry, assuming
occupancy.
Fully occupied, zero vacancy.
Yeah. And projected rent. So they actually sell the property based on future rent increases. So they're trying to sell
after you've renovated the whole thing.
Yeah, exactly. So it's just like, wait a minute. And I've seen so much of that. It's just ridiculous. But to your point, you know what? This is really good. Actually, we're talking about this because Erwin said this earlier. It's like these sharks that are out there. And for those that are looking to get into the multifamily space, we're kind of talking about this earlier, is, how do you kind of get into this? And I think part of this is, make sure you understand this business because, for those that are just in the residential space right now, you may have learned how to invest in single family properties. Okay. So your education level is here, and you can do this real estate at a residential level. But when you are looking at buying like a multifamily, you are not dealing with average mom and pop owner. You are dealing with another, hopefully, maybe a more sophisticated investor. And if you're not talking the lingo or the language and you are trying to buy multifamily with this type of knowledge, you're going to get eaten alive. Right. Okay. So you need to get yourself, I don't care if it's YouTube videos or you're talking with Erwin or what, understand the game, no different than what you learned in the residential side. So you can at least talk at that same level and you can understand this, or else you're buying based on emotion versus kind of using your noggin to understand how valuation's actually being calculated and does this property fit what your investment goals are or not. So
it's very different. For example, I was talking to an investor earlier this morning and he kept on referring to his house as being lot value. Because that's where he lives. Houses aren't worth much. People only pay based on the lot.
Yeah, right. Okay.
But that's only true in houses, right? Where in certain cases it can be where a lot of the value is. It's not the same at all with an apartment building.
Totally, 100%. It's not at all. Like I said, you're buying a business at the end of the day. You can have two 10-unit buildings side by side. Values could be completely different, even though they're built by the same builder, same size, same everything. But one's just managed better than the other. You would get two different variations of the price for sure. So
absolutely. Okay. Is there phase 3? Do we need to cover phase 3?
Oh, let's see. Okay, so we got phase 2, phase 3. So so first of all, we've got acquiring
for phase 2.
Yeah, so there's no phase 2. So I think the big part is you go through the information of phase 1 would be really just getting the offer accepted, reviewing the your pro forma, making sure it's accurate. Then you kind of go to the phase 2 study, phase 2 part, which is due diligence, checking your number. So, and then I would actually say phase 3 is actually the aspect of environmental engineering reports, all those things, right? Once you've checked off all of those boxes, and again, you know, I think the important part is double check, triple check, quadruple check, you know, talk to other people, talk to other multifamily investors, get a second set of eyes, share what, and I think the biggest one is when you're looking at a multifamily, what's the strategy? Okay, what are you doing this for? Okay, what's the plan for this? It's just like a business, okay? Am I just buying it and then I'm going to just rent it? Or is there opportunity to increase valuation? And so when I say that, that means you're trying to increase the net operating income. And so for every dollar of increased net operating income, you increase the value of the building between $15 to $20, depending on the area. And so just so for people that are listening, net operating income is your gross income. Okay, so it's all your income. It would be laundry income, rental income, whatever that is, minus all your expenses, not including your mortgage. So income minus your expenses. Okay.
And that's operating business.
Yes.
Anything that costs you to operate the business before debt.
Totally. You got it. And then, so with that being said, you're trying to increase that dollar per dollar. You're trying to find opportunities to raise that by increasing your net operating income. You increase your property value. Okay. Your business value. And so that's the game. That's the goal. And so is there opportunity? Is there things you can be more efficient in? Is there expenses you can reduce? Maybe you can get the tenants to pay the utility bills, which is one huge aspect you can do. Is there ways you can raise the rents? So what's your plan? Are you planning on renovating suite by suite? What can you get increased rent for? So I think before you start kind of getting into multifamily is understand you are buying a business, but what are you trying to do? Like, how are you going to increase the value? It isn't like residential where, you know, you're based on the market. There's some factors to this, but there's lots of ways you can create forced appreciation in multifamily properties. So, yeah.
I'd add to one of the phases, I would reference check the seller as well.
Oh, gosh, yeah, for sure.
I want some information about them.
100%, for sure.
Yeah, I always like to know who I'm dealing with. At a minimum, I check their LinkedIn. At a minimum.
At the minimum, yeah, like at the minimum. Like I think in this day and age with social media, I think we were talking about this before. There's so easy to kind of go on social media and just kind of get a sense of the individuals that you're dealing with, for sure. Yeah, the more information you get, the better it is for you, right? So, yeah.
Yeah, a friend of mine, he had conditionally sold an Aplex. And just in passing, I said, "Oh, who's buying it?" He goes, "Oh, this person." I'm like, okay. I open my Facebook, search his name, find him. We're already friends. I just like 3 swipes, scroll down, like, oh, I know who his coaches are.
Yeah.
So then I have again a good idea who his friends are. I just give him the heads up. Like a lot of these folks in this community are not doing well.
Yeah.
So then once you have that information, then you know in your negotiations, and so he did it. I think I influenced his negotiations. Like for example, like I believe he needed an extension. Yeah. So I told him, like, you know, I'm pretty sure he asked for more money, non-refundable. Yeah. You know what I mean? To see if this guy's for real. Right? Yeah. Don't waste someone's time. Yeah. But yeah, it worked out. I followed up. It worked out. So,
fantastic. Yeah. That's good. Yeah. That's great.
But again, he appreciated the heads up because like, I can't like, you know, we're friends. That guy and him and I were friends on Facebook. Like, so all I did is type in the guy's name. It's not that hard.
No, yeah, for sure. And I think you'll find the same people over and over again because when you work with when somebody's investing in multifamily or you see a property that's for sale, like say for example, as one of my properties, I don't own just one property. I own lots of properties, and you'll see the same thing, same trend kind of happening with others. And so don't ever be afraid to ask the question: are you selling any other properties? And if it's a good if the process of the transaction went well, yeah, maybe we can explore maybe selling more or buying more. I try to do that to my best of my ability because most of these people are multifamily owners. And the same thing is with the reputation. It's we talk about real estate investing as a small community, and it's true. The guys in the multifamily space is even smaller, like really, really, really tight, really, really small. The amount of realtors out there and property managers that manage this space, the investors that are in this space, it's not a very big industry, right? So you don't want to ruin your reputation by any means. So
especially in a small city like Edmonton or Calgary compared to like a Toronto.
100%.
Versus to GTA. Like, what is the population of Calgary?
I couldn't even tell you, to be honest with you. Later. Yeah.
I don't think it's massive though.
I'll have to Google that one. Wikipedia.
They have a hockey team. They must be decent size.
Yeah. Well, they're doing better than Vancouver. Sorry, guys. Vancouver.
Is there a phase 4?
No, that's pretty much it. So at the end of the day, once you've kind of gone through the process of due diligence, you've double checked all your numbers and reviewed it. You kind of sign off no different than what you do in the single family space. And, then you've got, normally it's about 30 days before you actually come to completion and close.
That quickly, eh?
Yeah, it's usually
30 days to close.
Usually it's around 30 days to close, right? So you've gone through the process of due diligence. That process can take between 45 to 60 days as an average rule of thumb, depending on the financing. If you're getting CMHC, it's way longer. And then after those 45 to 60 days, then tackle another 30 days to actually close. There might be a preparation of documentation. Maybe you're setting up a corp. If you're bringing in partners, adds more complexity to it. So you'll need to kind of budget for those things, but it does take about 30 days usually on a general rule. And I think for those that are getting in the space, the best advice I can give you is, it sounds like the purchase process is long compared to residential. Like, residential, you can probably get most of this stuff done in about a month. And you can do it even faster than that. But in multifamily, time goes by very, very quick. To do an environmental study takes about 3 weeks. To do an report. So you got a lot of time. You don't have a lot of time. So the more you integrate your team at the very beginning, almost at the time of offer acceptance, then you've got everybody aligned to making sure it hits your timelines. Again, these deposits that you're putting down, they're big dollars, right? And sometimes banks will say, just they giving you kind of a rough conditional approval, they still can walk away from the financing if they feel there's too much risk. And it's happened. I've seen people really, literally they're about to close that day and say, we're no longer interested, and pull away. And so it puts people in really awkward positions. So, get people involved right as quickly as you possibly can. 45 days or 60 days to do your due diligence and condition removal. That sounds like a long time. It really isn't. It goes by very, very fast. It goes really quick. So,
right. Especially if it's like your first, second, or third time.
Oh God, yeah. Like especially your first time, you just don't expect it. And so, for those that are getting into the space, just understand time goes by really, really quick. Don't use every single minute, every single hour to kind of make sure that you're pushing everything forward constantly. So
what do you do for your clients?
In what way? What do you mean?
Because I imagine, because we've said a lot, for example.
Yeah, sure.
Buying a business is not for everyone.
Heck no.
Right? Most people did not go to business school, first off.
Mm-hmm.
Most people who are buying these things that I know have never run a business before.
Yeah, it's true.
Most investors I know are generally employees.
Mm-hmm.
We're talking about buying a business. It's a whole different, people spend many, many years studying how to go into business school and whatnot.
Yeah.
Becoming an accountant, all those sorts of things.
Yeah.
I imagine someone needs their hand held.
Yeah.
Do you hold hands?
For my partners and my money partners, is that what you're saying? Or
Anyone
just
else?
for anybody, coaches? But yeah, for students all the time, constantly. It's a constant process. Like, for me, when somebody hires me as their coach, or they're wanting to be, even just students of mine that are like, so for example, we do more of a group setting training, and I also do individuals that really need hand holding.
Especially during a live deal.
Especially live deal.
Yeah.
And so I tell my students, and this is not any extra, this is just part of the process. This is just service that we try to provide. It's like, if I've taught somebody how to invest in multifamily, and I tell my students this, I am expecting you to call me on your first deal. Like, I want to filter it, but the comment that I always share to my students is, you are going to tell me why it's a good deal. It's not the other way around. I will obviously vet it and review it and pick holes to it, no different than I do with my own deals. But absolutely. So I want to make sure that they have clarity and they understand exactly what's going on. So same thing even with my partners. It's the first multifamily deal. Like they've entrusted me to just do the work and just manage it on their behalf. That's why they've hired me in the first place, is they just don't want to do it respectively. So they just want to make a good return on their investment. It's great. Happy to work with them. But I think it's still important to understand the business. They are my partner. And so, for me, I do quarterly reviews with them. We go through the financials, go through bank statements, updates on the property. Are we to budget every single year? We have a 5-year projection, no different than like a kind of a 5-year projection of where we're going to be at those particular stages. We do annual reviews. And so it's important to kind of make sure that you're communicating with your money partners on a regular basis, how you are managing your properties and things are working well. And then the same thing also goes with your, even some of my students we do hold their hand through the whole process. This is like, okay, these are the steps. What, how did you negotiate this? Setting the tone, making sure the offer's written well for them. So they're not, put in an awkward position where they run out of time. So we've got all these little tips and tricks that we kind of use in our purchase offer to protect the buyer. And then obviously going through the process of due diligence, they put their numbers together and they just reassess it, help them with negotiations and all those stuff. That's the easy part. It's kind of the acquisition side. The second part to that whole process is the strategy. What are we going to do? And increasing valuation and executing what the plan is. And so that requires a little bit more hand holding just to make sure they are launching it well. So from day one, once they've got the keys, they are going, like they're moving forward. Because in a lot of ways for multifamily, people are trying to refinance it after a year or maybe 2 years. And so it's kind of like, all guns a-blazing at the very beginning to make that happen. So
I still have a lot of questions. You just mentioned that the refis are usually 1 or 2 years. Why does it take so long? What's happening during the first 2 years?
Great question.
1, 2 years.
Really great question. So, when you got to...
Because we were joking. I actually have a bullet point to say this is fast and furious money making, right?
Fast and furious. A year.
This is fast money, right?
So fast.
Get rich overnight.
Rich overnight. Exactly. That's all it is. Lamborghinis, boats, all that stuff, all that fancy stuff. That's what we are.
You have a Lamborghini collection, right? One for every
I've
building?
got one for, it's right beside yours that you have downstairs.
You have 75 Lamborghinis, one for every building. But yeah, what does the 1 2 year process look like? Because I want people to have the expectation of like what does it feel like?
Sure.
What's the cash inflow, outflow, whatever.
Yeah, I think part of it.
I'm sure you have to do this for your
100%.
students. Like, set the expectation? What
Totally.
is the expectation?
Yeah, I think part of it, it's like there's always this expectation that you're going to do this really, really quickly. But as everybody's well aware, cash is always tight. It's even more tighter than now than ever. So you're kind of systemizing this as well. So you're looking at when you got a building like, let's just keep it simple and say 10 unit apartment building, okay? And you may see an opportunity here where the current rent for the property is like $800 a month. And you have the ability to raise that to up to $1,100. But you may have to improve the overall look of the building or the units first to get it to that level. So that means maybe some new flooring, some painting, maybe some kitchens or whatever the case may be. You're not going to vacate the entire building to do that, because why would you do that? And because sometimes it's just not going to happen. It's just not going to work. So you may work floor by floor. You'll go broke, right? Because, we're talking.
Please don't go broke, people.
Well, think about that is, say at $800 a month, $800 a month, times 10 units, that's $8,000 a month. That imagine the whole property vacant and you're losing $8,000 a month, like that is of income, right? So you don't want to necessarily do this. You want to kind of stage this out a little bit. So the initial steps are, you look at the lease agreements, lease terms and stuff like that, and when they're going to come up to renewal. Most of the time when you have units that are maybe month to month, or they're month to month, or they're coming up to the end of the term, those are the ones that tend to kind of move the soonest, right? So then all of a sudden, you may not be renewing it. Then you go in and take it over and start renovating those 1 or 2 units. And then you start kind of planning out your lease based on lease terms is when, hopefully you can get these 2 units rented. And the best part about this is you can start communicating to some of these other tenants that maybe like the area, like the building, and say, hey, just so you know, we will not be renewing your lease for this particular unit. So we're just giving you a notification now based on whatever government policies are. We are going to be renovating it. And I know what I'm saying maybe doesn't work in every single province, but I'm just sharing what we're doing in the provinces that have the ability to do that. But with that being said, we give them the first opportunity to maybe rent the other units, the brand new units, at the higher level. And then once we start to maybe make those transitions, and it's actually quite high, believe it or not, they're like, yeah, I like the area. I got a brand spanking new unit, or maybe a newer unit, then I want to move into that, right? And then you start kind of working your way down. And then obviously you will have some vacancies that you will have to address, and you may have to eat 1 or 2 months worth of rent. But that's part of the planning process at the very beginning, right? And I think that's, another big lesson for everybody is make sure you have good reserves. That's my lesson that I learned years and years ago is reserve funds, right? But even more so when you're doing something like this, over budget, really over budget. And so
both time and money
for everything, right? And go aggressive. Like I tell my partners all the time, I'm like, in my analysis, you'll see the numbers be the highest compared to everybody else. Like you can work with other real estate experts. Mine will be the highest 100%. And the reason for that is because I don't just budget for the 1 or 2 years. I actually budget for a 5-year time frame in regards to owning this building. What can come from that is within 1 or 2 years, I got too much cash. So all I'm going to do is give that money back to the partners at that end. But what this is doing is it's not me constantly asking partners for money, which has this negative connotation. I'd rather be honest with them and open and ask for that up front. So with that being said, you're capitalized well to kind of go through the process to do the renovations, but it is a step-by-step process. So you're dealing with lease agreements. And so that's why I say a year or two, because you might have some challenges with tenants that don't want to leave. Renovations might take longer than not. You might come up to some surprises that you didn't want to hear, right? And so you're kind of
fired general contractor.
You just never, does that happen?
All things come out.
You know,
all these things happen.
It just happens. So you kind of plan for that scenario to kind of come to fruition, and so you always plan worst case scenario.
Right.
And
plan for a pandemic.
Yeah, exactly. Right. So it's all those things, right? And so it's all those aspects that you try to plan for. So again, you're dealing with lease agreements, you're dealing with renovations, repairs, all those kind of things, and also raising rents. God forbid there's a higher vacancy rate or something like that. But that is kind of the stepping stone process. Once the building gets completely full at the higher rent levels, at that stage, now you can go to the process to the bank because you can show lease agreements, you can show rental income coming in, even though the months previous have not been good because you've been doing this, but they can see what you've done to stabilize this. They will look at that new valuation based on the new rent income side of things. So that's kind of the steps. Yeah.
Hopefully the listener's happy with that answer. I want to move on.
Yeah, please go.
I want to ask about partners, for example. When should someone have their partners lined up? In the middle of phase 4?
Oh, no.
Phase
no,
6.
No. How about phase -4? How's that? Before you even know you've got a building. How's that?
Before have building.
Before you have the building.
I see this. I feel sorry for this lady, but she got firm offers on property, and doesn't have a money partner. Like doesn't have the money to close. Yeah. No, that's wrong. You're saying, what do you mean?
It's the biggest mistake that I see from investors. It's one of the biggest. There's actually a lot of mistakes I see, but this one's a big one because I've seen people lose out on really some amazing deals. Really lost some amazing deals. And so with that being said, the time to have your money lined up is way, way before you're even looking at the building that you're about to buy. Okay. And that may sound really weird. And you've heard this, Erwin, and you're a longtime investor, and I can't speak to all the speakers that you've spoken to, but at the end of the day, people are not investing in a deal. They're not. They're investing in you as an individual and trust and credibility. And so once a money partner says, I trust you, okay, like, and when I say that, 100% trust, like I trust you, Erwin, with my $100,000. And you're not going to
Costa zeros.
Yeah, and maybe some zeros. And you're not going to Costa Rica with that money. Once they say, I have confidence in you, the deal is completely irrelevant because they trust you 100%. So if I went to my property, if I took to my partners right now and say, hey, I got a property in Tuktoyaktuk, and this is not a knock at Tuktoyaktuk, I'm just using it as an example.
It's a real place.
It's a real place.
Okay, I had no idea.
But if I brought it to them, I would have partners for that because they trust me, right? And they trust me wholeheartedly. And so that's what they've hired me to do. So, what you're selling and what you're doing to raise capital is never selling the deal, is selling yourself. Right. And so how people can be confident and trust you. Don't get me wrong. You still need to present to your partners the deal, but you should have most of that lined up probably 90 to 95% of the way by then. And so, with that, now you're just presenting the deal and see if they want in or not. But that should be coming to conclusion in like a day, really quick. So you shouldn't be spending your precious quality time. We talked about how time goes fast in the due diligence. You shouldn't spend that quality time raising money. That time is for due diligence. And so if you don't have money to buy a property, a multifamily property, you're spending your time doing the wrong thing. You need to spend your time raising money, not be looking at a deal, period. So
damn, someone DM'd me on the weekend. There's these 5 great properties in XYZ city.
You can pass them to me if you want. I'm taking them.
Can you introduce to me someone with money?
I can't promise you that, but no, maybe we'll work out something there.
And then how does someone secure the partnership? Because, for example, I've heard, I'm sure you've probably seen it too, where money partners are not as serious. How do you think of the newer investor, right? Now, how do they secure that relationship with the money partner? Oh,
that's almost an episode in itself. That's a long process. And so I think part of it is it's a screening process. And so, and when I say a screening process, your money partner is going to screen you for sure, right? Mm-hmm. They're going to ask you lots of questions because they want to see, hey, is Irwin going to Costa Rica with my money? Which I know Irwin would not, just so everybody knows. He's a good guy. Mm-hmm. But I think it's even more important for the real estate expert to screen the other side. Mm-hmm. It's an interview process on that end. And so you want to make sure that they've got some form of commitment and understanding. And more importantly, and the best example that I can give you is 2 things. Number one, you are going to be married with this person for, as an average rule, probably 5 years. Can you be with this person for 5 years? Like, mm-hmm. truly, like, mm-hmm. don't forget the dollars. Can you deal with this person for 5 years? Is there some compatibility? Do they have common goals to what you have? And can you work with this individual? Secondly, obviously, you want to determine they've got the capital to do so and that they are wanting to take action, or are they just wasting your time? And again, that's part of kind of an interview process that you need to feel comfortable with.
Mm-hmm. Because you're asking uncomfortable questions, like,
for sure,
Michael, show me you have money.
Absolutely, 100%.
Well, and then, like, listen, Michael, put the money in this account in Switzerland.
That's exactly it. And so for us, it's just like, we want proof that you are going to follow it through, right? And so I actually don't ask for deposits. It's going to sound kind of strange, right? Because I've been doing this a long time. I can vet my people quite well, and I just know where my flaky people are and my not. And so I still get people to sign a document, and it's a very generic, simple kind of letter of a commitment. And
commitment letter, letter of understanding,
right? And it just kind of follows our structure, right? And so I get them to sign it, and you will always have people have hesitation with signing. And if they have hesitation of signing, that is the biggest red flag. Yeah. If you got a problem now, don't get married. If you already know you've got an issue there, then you got a bigger issue. If you got somebody that you pass it over and they sign immediately and you feel comfortable, that's a pretty good commitment.
It's like saying, like, you want to get married in my church? And like,
I don't know. Exactly. And yeah, so I think part of what you have to do too is you will always have a small percentage of people that will probably not follow through and commit, but that's why you need to raise. So if you needed to raise like $1 million, you should actually be raising like $2 million or $1.5 million. So then when you have those individuals that maybe have cold feet, and it's okay to have a little bit of cold feet, or they're nervous, or something comes to fruition that they weren't surprised with, they lost their job, you've always got backup, right? So in this game called real estate investing, you never stop raising money. Ever, right? It's this constant engagement and connections that you should always be making, so you always have capital ready.
Michael, this does not sound like a 4-hour work week to me. I think we should shut this off right now. That sounds like work.
It's called work. This is a job.
All right. So the market's changed a lot.
Mm-hmm.
Like cap rates, give me context. What was cap rates when you first started?
Oh, good old days. Oh, probably 7.5%, 8% cap, somewhere in that vicinity.
What year, what market?
Oh boy, probably be looking at 2010, 2011, somewhere in that vicinity. Right. We were seeing stuff like that back in just prior to, maybe probably around 2002, 2003, 2004. So those were the good old days. Those aren't the good old days anymore.
But these are you've calculated caps. These aren't the ones that are being sold to you.
No, some of them are actually 10 caps. Actually, those are actually sold to me, believe it or not.
Okay, what were the real caps then?
So real caps, I mean, after we've increased valuation and stuff like that?
No, after you've done your due diligence and made the adjustments.
Oh, I'd probably say just maybe after we've done after we've acquired the property.
Just yes, at least after the diligence period, after you've worked out what the real numbers are actually.
Oh, I see. Yeah. Well, here's the thing is I've always pushed back on the sellers to get it to what I'm what they've presented back to me. Okay. Right. Always. Like I say, if they're presenting us back a 7 cap and it comes in at like a 6 cap, I'm pushing back.
After you've gone through the numbers.
After I've gone through it, I'm like, I don't know where mistakes. It's just like, I don't know where your numbers came from, but you sold me a basket of goods. This is what these are your actuals. So I was under the impression that you're selling me this. That's not. So to make it match this, then this is where it is.
Right.
And so
the price is adjusted.
The price has to get adjusted. Is it going to be getting to 7? No, it's not. But for me, it's just like it's maybe halfway in between to try to come to some reasonable settle. Yeah, and that's just the acquisition side. I am worried about what I'm paying because I want to be sure that there's opportunity in the deal, but I want to see really truly what the actual future opportunity is. So that's really, really important. I was dealing with a student just recently. He was so concerned about this $40,000-$50,000 variance in this, because they're going back and forth, and he's talking about $40,000-$50,000 in negotiations and at the price point. And he's like, I don't want to give it to him. I don't want to do this. I think I'm just really feeling uncomfortable with this. And I joke around. I'm like, I'm a very cheap Portuguese boy, so it's just by my nature and just the way I am. So I can understand getting a good deal, but don't lose sight to what the opportunity is. His upside was probably close to almost $500,000 in a very short window. So are you going to really risk that opportunity for 40 to 50 grand? I go, of course, negotiate this, but you're not going to walk away from this deal and piss the guy off. And then he's not going to do you any favors to try to help you come to a close, because he's still in the process of due diligence, and there's lots of things these sellers can do and not being accommodating to support that close. Don't risk it. It's not worth it for $500,000 for $50,000. Like this is bigger money. Like it's so much bigger than what.
Yeah, the seller realized what the opportunity was.
Exactly.
They're asking for more money.
And so don't lose sight. Right. It's important to kind of understand that too. And so to kind of go back, like I said, those are the good old days in the great old cap rates. Today, if I'm looking at Edmonton right now, you're probably pushing it like 5% cap, somewhere in that area, 5.25 if you're lucky. In Calgary, you're probably pushing around the 4.25, somewhere in that vicinity. So we're kind of getting to those types of markets. Moncton, you're probably pushing it around maybe around 5.5%, 6% cap, somewhere there, 6 if you're lucky. Halifax, again, you're probably pushing in those kind of like low 5s, early 5s, somewhere in that vicinity there. So like the demand for multi has gone up for sure, and so. Part of the problem that we find is there's a lot of investors getting into that, and unfortunately they don't know what they're doing either. And so they've overpaid some of these properties, overpaid. I'm not saying that's truly what the problem is, but it's not helping the cause. And so now you've got comparables at these extremely low caps, and that's what you're competing with, unfortunately. Like even myself, I sold some my properties in Moncton, I sold them all before they implemented their caps. Rent caps.
Rent control. Yeah.
Rent control, right? I was buying at just under a 7% cap. We increased valuation, and I was a little concerned. I was just trying to be a little bit forward looking, and I was taking a little bit of a guess, but they announced it in Halifax, and I'm like, I don't know. I've got this gut feel that they're going to be announcing it in New Brunswick, so I had to do everything. I just raised all the rents. There was no renovations done. I just raised all the rents. And really quick, and we sold it in 6 months. So we bought it for $950, raised all the rents. 6 months later, sold it for $1.515 million, and we didn't do any renos, nothing. So it's just, and about a month later after that, rent control came in. Okay, now that it's been removed, we might go open the door again. So we'll see.
And you sold it to the open market. It's not like you were like preying on your students or something.
Oh gosh, no, not at all. Like I think part of it is like here, there was some.
Stood outside one of these courses, one of these weekend courses, and handed out.
No, so unethical. I just can't handle that stuff. That's just like
how the buyers are, man.
Nah. Yeah, like that's just something. Like for me, I want to get my best value. I'm not going to sell that ethically to my students because I part of that is I'm actually not doing my investors a favor, or on the flip side, I'm not doing potentially my students a favor too. I teach them, try to look for opportunities. You probably won't find those opportunities in my deal because I'm trying to get the highest valuation. So I can't ethically just do that.
Let alone with rent control.
Oh, God, can't do that. Can't do that. It's not fair.
I jest.
Yeah.
But yeah, so at the valuation you sold it, you don't think made sense?
No, it didn't. And so that's the thing, you know, I sell it. I'm like, I don't know why somebody's buying it at this price. It just doesn't make sense. But it's their prerogative at the end of the day.
Any idea what the sales process looks like? Like, for example, you know, I'm friends with, we have mutual friends, and one of them explained to me how their objective is to be, when an agent has a property that's going to go up for sale, their objective is to be really high on that list for when they call.
Yeah.
So they are high on that list because they have a record of closing, right? Is that true? This is
100%.
Right. So then this is what I want. I actually told a beginner just yesterday. That's the reality of things. So I said to him, like, you know, between you and I, where do you think we show up on the list?
Yeah.
Assume the list is 150 names and no numbers. Where do you think you and I show up?
Yeah.
We're at the real bottom, right? And then it gets through all of us.
Yeah.
Probably gets it on an email list as well.
Yeah.
Right. Probably gets shopped around the brokerage.
100%.
And then it makes it on Realtor.ca.
Totally. Yeah. 100%. Yeah. It's one of those things
So you've seen it well before.
Oh my goodness. Like, you know what?
You're getting called? Are you getting called?
Oh yeah. I'll get calls. Yeah, I get deals that there's never ever been pop up at all. But those are really where the opportunities are. But again, I've been doing this for a long time. And so for those that are here,
you have a reputation.
Yeah.
People know you.
For sure. But that shouldn't discourage people, to be really honest with you. You're just at the bottom of the list right now, right? And so you just need to build those relationships with those people to move up the rank, and that's all it is. Right. So, you know, do your part to work with your team members, build those types of relationships with them, and it may sound kind of like, you know, it just may sound kind of a little bit unjust, I guess, but it's just, you know, take your realtor out for lunch, build relationships with your property managers, build relationships with your photographer. Like, it's funny. I had a photographer, he takes pictures of our rentals. Okay. But he takes pictures for realtors as well, like for showing properties and stuff like that. He was taking a picture of an apartment building that was about to go out to the market. And he called me from there and say, hey, Mike, FYI, this property is coming out on the market in advance. Here's the seller. Would you want to talk to him? Right? That's from my photographer giving me leads. And so it's communicating what you're looking for, what you're trying to, and build those relationships. Property managers are managing these properties. If I am looking to sell one of my properties, guess who my first call is going to be? It's actually my property manager to give him a heads up. First call, number one. Okay. And so with that being said, he or she may not want to sell that property, and he or she may not want to lose that property. And he can talk to the owner and say, hey, I've got somebody else, another owner that I'm dealing with, or somebody else that might be interested. Would you want to maybe do this as kind of a private sale? Kick the property manager a few bucks just to say thanks for the lead and call it a day. But those are the types of relationships and discussions. Your lawyer, like, there's all these inside discussions that tend to happen. It happens in business too, right? All the time. It's so you just need to get out there and connect with those people, and you may not have that really tight connection right now, but that's what you got to strive for and build for, right? So, yeah.
Are you doing that in Vancouver? Because I'm leading you within my question. My leading question is really, like, you know, you mentioned like Moncton, New Brunswick, or Halifax. How do you foster those relationships? Like, it's the other side of the country.
Totally.
That's a long flight.
Yeah.
How long is that flight?
Yeah.
Vancouver to Halifax.
Halifax, that is, I think, 7 hours. Yeah, 7 hours. Yeah.
So are you getting on a flight to buy these people lunch?
Yeah. Well, you know, there's lots of things that I can do from that. So, for example, you know, I was just in your office. I saw lunch being served here, right?
Okay.
And a wonderful thing.
You didn't touch it because
I didn't touch it. I want to respect it. It looked amazing, by the way. But
Their body's a temple.
The body's a temple, right? But no,
you don't believe me, look up Michael's picture.
Don't look at that. That's the old pictures, right?
Oh my God. No, Adam, Michael was literally a bodybuilder. Like, abs everywhere.
Nah.
On his forehead.
Yeah, forehead, ears,
feet,
yeah,
abs everywhere.
feet, yeah. No, there's lots of things you can do virtually, and I think that's a little bit of a change. But there's a lot of stuff you can do, like even sending lunch in by surprise. These small little gestures, small little ventures, gift cards go a long way as well. But it is building and fostering those relationships. But obviously, when you are there, take them out for lunch, take them out for dinner. And you know what? Talk about everything but real estate investing. This is about connections and just building those relationships so they can feel comfortable with you.
Because most people don't do these things.
No, it's changed so much. They just like, hey, I talked to this person, but I haven't seen any leads. Well, you know what? You just haven't made it up that list yet. So work really, really hard to connect with those people so you get first access, right? So yeah.
You're adding to my 4-hour work week here.
I'm sorry, my friend. I'm sorry.
Because to be honest, everything you've talked about here is like you have to have a lot of skills. You should have some basic accounting skills, some analysis skills, you have some sales skills, relationship building skills, operational skills, probably some landscaping skills.
Well, if you're planning on doing some of that stuff, like in a lot of cases, these relationships and things, these are things, all the stuff that I'm talking about is what you really have to do at its very infancy. Is like you got to work really hard, just like any business. The hardest time in a business is the first 2, 3, 4 years. You got to work and relationships. Then at some point in time, you start to kind of delegating. Like for example, bookkeeping. I don't do any of that stuff, right? But for me, it is more still customer relationships. They still invested it with myself, and so I still want to make those connections. You spend a lot of time raising money, right? And so you got to constantly be raising money. I don't really need to work too hard for that anymore, because you know what? The money that I currently have with my existing partners, it's rinse and repeat now. Right. And now we've got such track record. They're just providing me with referrals. So I'm not necessarily needing to go out hunting too much anymore for that kind of stuff. Right. But for those that are wanting to scale, you can't just expect that you're going to have a very successful business without working. You have to work really, really hard to have a successful business.
I've graduated weekend course. I got this.
I won't talk about that.
For context, Michael, what amounts are your money partners putting into a project, and how long have you known them? How long have you been working together?
So
just an idea.
In some cases, I've been working with them for probably around 16, 17 years. And so as an average rule, when I kind of first started, the magic number is between $50,000 to $65,000 as an average rule of thumb. That number is definitely bumped up to be somewhere in the closer to around $85,000 to $125,000. We do it in share increments, so we have specific shares. But my partners now, so say for example, we have a project that may have 10 equal shares in the corporation that owns the property. Each one of those shares will equate to say about $100,000, just a general number, right? And so we keep our shares very minimal because we just look for quality money. And so with that being said, we have individuals that are buying 2, 3, 4, all shares. It doesn't, we have people that just say, you got 10 shares at $100,000. Here's a check for $1 million. Thank you very much. And they just call it a day. And again, this is the relationships we've built. And more importantly, that we've been working with them really closely for years, right? So, but it's taken some time to develop that, right? So,
now how does someone get started? For assuming it's still a good idea to invest in multifamily.
Oh God, yeah, for sure.
How does someone get started? That's Adam's question.
Yeah,
we had a fan whose name happened to be Adam.
Adam
wrote in.
Yeah, really popular guy. Yeah. No, it's one of those things. I think if you're going to get started in multifamily, which I think is the question, correct? So if you're looking to get started in multifamily, take the time to learn a little bit. Understand what you're buying. Don't pretend that, hey, you know what, I've got 20 single family homes. I'm a sophisticated, big-headed investor, know what I'm doing. It's a different game, completely different game. Go back to day one and start your learning no different than what you did when you first started learning single family home. And if you go in with that type of mentality, you'll have a lot more success because you are buying something different. You're buying a property, yes. Your customer is a tenant, which is similar to single family. Yes, the business is very different. So take some time to learn. Like, what is it exactly you're buying? How are you managing this kind of stuff? You're going to be dealing with different people. Like your single family realtor is not going to be your multifamily realtor. Your single family property manager most likely will not be your multifamily property manager. Your single family,
handyman,
your handy, everything changes, right? So, and more importantly, it's like, when you're buying this, you got to also think strategy here. So this is what it is. It's like, it's not just buy a property and hold it. It's what's the plan? What's the strategy? So learn those things of when you're about to buy it, that you have a very clear plan of what you're going to do with it after. And so that's what investors need to know. And it's not to scare people. It really shouldn't be. It's actually a great investment strategy. But it's just taking some time to kind of educate yourself first. And like I said, I'm not here to pitch courses or anything. I'm not one bit. But read YouTube videos. There's lots of great free information that's out there. If you really want to push yourself and scale and do it, maybe take a course or two. And again, it could be not anybody's course. Do your research on who the person that you're learning from, and do your research on the course itself, and do your research on what the students got out of it, and do they feel that there was value. Connect with these students. Like if they've got testimony, connect with them, ask them, what did you find value of this? Did this help? What did you buy multifamily after you've done this? So start to kind of get yourself educated to learn this business, so you can kind of go in, again, like I shared, you want to talk the same language. And that's what I want is, and even more importantly, hopefully your education doesn't just kind of keep you at this particular level with your other investor. I'm hoping that whatever education you've got or whatever knowledge you got is going to help you, make you even more sophisticated as well, right? And that's kind of really the strategy. And then from there, my other small bit of advice, you're dealing with bigger numbers. You're dealing with a different strategy. Dip your toe in the water. Okay. So don't buy your first property as a 100-unit building. Okay. Buy yourself something maybe a little bit smaller. And, I was talking to some amazing guy named Adam or something like that. And I think, he was referencing a fourplex. A fourplex is still falling under a single family, which is still a good segment. It's still really, really good, but anything 6 and over, but I still kind of want to push people to kind of really consider like 7, 8, 10 units somewhere there. Dip your toe in the water. Yeah, you know what, and people will challenge me, especially other investors, and they'll say, why would you do that? You're not going to get the best economy of scale and all that stuff. And that's true. It really is. But making these really big, costly mistakes can be very, very costly. So take the time just to dip your toe in the water. And the reason why I share that is I did the same thing too. And trust me, saved my bacon multiple times. It's just that I've just kind of go in, dip, and then figure things out, make sure everything's working out. And now I'll start to work on some bigger aspects of this. So,
could someone be like start off learning? Because I look at the co-op intern model, for example. Could someone just be a passive investor and like come along for the ride and
totally
learn everything from somebody?
Yeah, absolutely. Like I think even for partners that I've worked with too. In fact, I've got one that is here that I'm meeting up tonight. Actually, he's one of my partners. And that's exactly what he's doing. Is he became one of my partners as a joint venture partner, and he was very open and disclosed this 100%. He goes, Mike, I just want to invest with you on this deal, but would you do me a favor? Can I go on the ride with you? I'm like, absolutely. Come. Like, let's go. So they got a chance to go part of the inspection process and learn and
Sorry, are they a student too? Are they a student too?
They are just an investor. So he's just an investor. Oh, wow, okay. Just an investor, not a student. So he just wanted to be part of the process. And so
you're going to have like 10 requests for student co-op investors.
I actually really don't mind, to be honest with you. I really, truly don't mind, because like I said, the more they see the amount of work they see the amount of work that comes along with this, then more importantly, it comes to the conclusion, do they really want to do this or not? Yeah. And so for some people, they just say, I want to be a multifamily investor. And then when they see the amount of energy and effort that comes along with this, they're just like, you know what, Mike, I don't really want to do this. So here's just my money and off you go. Yeah. But I'm not pushing them to do that. It's like, this is what it takes to do this. These are the reasons why I've done it the way I'm doing it. So you can think about it.
To get it where it is.
To get it where it is. Right. So when you go buy your deal, just remember this stuff. And I'm not pushing them to come reinvest with me, because they've been open with me at the very beginning. So I want to respect that. And I do want them to be successful in whatever acquisition that they have in the future on their own. And I hope the experience that they had here with me was positive, and they've been able to relay that back to their future deals. And I want no credit on that. It's really them. They're the ones that are taking the action. They just needed a little bit of hand holding to support that. Good. That's great. Awesome. Love
Action
it.
and a fair amount of effort.
Totally. 100%. You know, but I'll be honest, when people kind of go through the hand-holding process in acquisition like that, there's a high percentage that people just say, I don't want to do any of that stuff. I just, you know, I want my kids, spend time with my kids. I want to do this. And so they're just like, here you go. Right. And because I have a lot of money partners that say that they just don't want to do it. So
I know you can't answer this, but isn't that a better use of your time than taking a weekend course?
I don't actually believe in weekend courses, so that might be a surprise.
Oh boy!
I might be opening up a can of worms, but that's just my 2 cents. I might.
Michael's cell phone number for your.
No. So anyway, I'm not gonna. Yeah, sorry guys. I just not the way.
We're gonna say your social media, so Michael's DMs are open for hate.
DM accordingly. You know what? I'm okay with that. That's okay.
Yeah, I think we covered. Oh yeah, because the point I was trying to make with someone investing alongside you, because we talked about before we were recording about the right deal, because I think that's where I think investors can get it wrong at many places. If you're investing in the wrong deal, you're doomed.
100%.
Right? Like you have not given yourself a chance.
Totally.
Right.
Like I think that's the part of it is, and you know, if there's a bit of advice I can, you know, share with people here, and hopefully I'm sharing advice with people, but I think the important part is do not invest based on emotion at all. Yeah. Ego is huge, right? It's a big one, especially in the space.
I got 100-unit building.
100 building. Exactly. It's all that. I just bought my 20-unit building. I can't wait to post this on Facebook, you know, and they're just like, under contract. I just bought it. Not realize, and they're making themselves look so good until you get to the meat and potatoes, and it's just an absolute dog. And it's funny because there's deals that I've gone in, taken a look at, and it's been presented to me. And I look at it, I'm like, I'm not touching this thing with a 10-foot pole being posted on social media, you know, 3 weeks later by somebody else really excited and amping themselves up. And I'm just like, I don't know what they paid for it, but it was a bad deal from what I looked at it, right? So the ego has got to stop, and sorry, not to stop. You just do not let your ego and emotions get in the way of what is important in this game, which is the numbers. It is multifamily truly is 100% all about the numbers. It is, when you look at it, you understand it. It is as clear as crystal clear can be. You know, can there be some minimal variations? Yes. But if you understand those numbers really well, you can have a lot of success. From my perspective, it's actually one of the more safer investments out there because you're not so dependent on what's going on with the market. There's so many things you can do with it. And pivot around to make you successful in this one.
If done right.
If done right. And to add more to it is when I say done right, it's also right for you based on what your why is. And I know people say why, but it's the truth. We all get into this game for a specific reason. In a lot of cases, I want freedom of my time, or I want to be a full-time real estate investor. It doesn't matter what it is. But is this project getting you closer to what your objectives are to begin with? Or not? It's a simple answer, and that's the right answer. And by looking at the numbers properly and finding the right deal to get you closer to there, you'll be in a good spot.
Yeah. And having a quality pair of eyes vet your deal for you.
For sure. And it doesn't have to be a coach or a mentor. It's just maybe having another investor that knows what the heck they're doing or whatever it is. Yeah. But don't be afraid to have a second set of eyes. Even for myself, I have people that look at my deals from time to time. Just, hey, I'll present it and I say, just need a second set of eyes. What do you think? And let's talk about it. And have you thought about this? Have you thought about that? It's just check and balance, just making sure. And I do the same thing in return. So,
right. But you're talking to an investor with over a decade of experience. You're not going to talk to someone with 5 years of experience.
God, no offense to the people that are doing it. It's not to say there's no great investors that have only been doing it for 5 years. Right. But again, just like anything, it's just
in general.
It's just in general rule. Like, you know what? You want people that have gone through cycles. Honestly, that's the truth of it, especially for people that have, looking for coaching or advice or any of those things. Like, get them through a cycle before. I've had times in my buildings where, we're dealing with 20-30% vacancy. It's not pretty. It's not pretty at all. And so how do you be creative in those types of approaches? So ask those questions from people, have you been through this? Oh no, I've just been riding the last 10 years. It's been amazing. The prices are going up, rent's going up, making lots of money. Okay, everybody can make money when things are great, and everybody can look like a sophisticated investor when everything is going great. The real good investors what have they been able to do to overcome the downturn and still survive? Those are the ones that I want to talk to. So
this is ultimate stress test right now.
Yeah.
Michael, thanks so much. Any final words?
No, I just want to wish everybody success. And like I said, I know can be a challenging time for everybody. And I know a lot of people are, because I've got a lot of people reach out to me as well. And I think the important message that I want to relay with everybody is you guys aren't alone. Everybody, and it's real estate still is a great investment strategy when done very right and very well. And you got to remember that the challenges that we're facing today, a year or 2 years from now, you probably will look at this and say, man, those are some really good lessons. It's just hard to visualize that at this very, very moment. So surround yourself with people, talk to people, try not to keep it all in. I think the more you engage with individuals and share some of your challenges, I know it might be really challenging to do that. It'll give you the support that you need to help you overcome some of the challenges you're facing, get the answers that you need, learn from other people in regards to helping you support them. And I wish everybody success in their investing journey, truly do. So,
in the Savvy Facebook group, anyone can join it?
Yep, absolutely. Come on. So Savvy Investor, you can actually even go to our website called thesavvyinvestor.ca, thesavvyinvestor.ca. You can get links to our Instagram, YouTube channel. We've got lots of free education that's there. No cost to that. We even have some interesting guest speaker that has joined me today that's on there. Mr. Irwin's also done a presentation there as well for me in the past. Cherry Chan as well. And yeah, definitely sign up for our Facebook group under Savvy Investor and connect, engage, talk, share. That's what it's all about. There's no selling that's in there. It's just all about communication and supporting each other as a community. So
thanks so much for doing this, Michael.
Appreciate it, buddy. It's great to have you and nice to see you. So
thank you for watching. If you want to learn how to invest in real estate from scratch, my team teaches beginners how to use the #1 investment strategy that I personally use in a virtual free training class every month. Go to investortraining.ca/YouTube to register for our next class. The link's also in the description as well. I publish at least 2 to 3 videos a week here, so subscribe if you want to keep learning from seasoned investors like myself and my guests. And if you're just starting out, feel free to ask questions and comment below, and I do the best to answer each of those comments and questions myself. Again, if you're ready to learn the nitty-gritty about real estate investing from a professional investor, register for our next virtual class. That's at investortraining.ca/YouTube. Thanks again for watching. See you in the next video.